market-led transition. This issue affects a broad range of market participants, and we are looking to the market to coalesce around constructive solutions. Second, while the end of 2021 is a frequently cited date, market participants should not wait to think about transition. The sooner market participants act, the easier the transition will be. And now I'll turn it over to Chair Powell to see if he has some comments.
Thanks, Mr. Secretary. So as Randy and Ken and the Secretary have just described, the FSOC is engaged in an important partnership with the private sector to ensure that our economy and financial system are protected from the potential end to LIBOR. The members of the ARC conducted a thorough, open, and transparent process to select SOFR as their recommended alternative to U.S. dollar LIBOR, and they are now investing heavily in the systems and operational changes necessary to support SOFR trading. Members of the FSOC must do no less to help them succeed, because we have just as much at stake in the success of this endeavor. OFR's proposed data collection will have a number of benefits, and one of them is that it will help to underpin SOFR, ensuring that it will remain a robust IOSCO-compliant rate over the long term. For these reasons, I fully support the proposal to share this data with the Federal Reserve Bank of New York as the administrator of SOFR. Thank you.
Thank you. Would any other council members like to make any comments? Okay, thank you very much. We will now vote on a resolution authorizing the OFR to share with the Federal Reserve Bank of New York the information that the OFR will collect under its rule on centrally cleared repo data. Is there a motion to approve the resolution?
So moved.
Is there a second?
Second.
All in favor?
Aye.
Any opposed? Thank you. The resolution is approved. For the next item on our agenda is Brexit. I'd like to turn this over to Undersecretary David Malpass to provide an overview.
Thank you, Mr. Secretary. I've been asked to make remarks on Brexit. As the Secretary has previously stated, we support an outcome to the current negotiation between the UK and the EU that will result in a successful transition to this new economic relationship. We're hopeful that the European Union and the United Kingdom will successfully negotiate a withdrawal agreement that provides for a transition period and orderly Brexit. We would note, however, that as the timeline for action gets shorter, the need to address potential financial and economic disruptions increases. Should the UK leave the EU without a negotiated withdrawal agreement, it would precipitate a so-called hard Brexit. The U.S. Treasury Department, together with our financial regulatory colleagues, is working with counterparts in both the EU and the UK to encourage a smooth transition. This includes our engagement through our regular bilateral meetings and also from our standing U.S.-EU and U.S.-UK financial regulatory dialogues. We are also engaged in U.S. government-wide Brexit coordination efforts with our EU and UK counterparts. From the U.S. perspective, our economic goals include, one, that we want to ensure that potential spillovers, particularly in the event of a hard Brexit, are mitigated so that financial stability is maintained. Number two, we want to preserve deep and liquid global capital markets, including the new thriving transatlantic financial services industry. And three, we also support Europe's efforts to deepen its capital markets and create a closer economic relationship between the EU and the UK that would help mitigate potential market fragmentation after Brexit. In light of these goals, we are concerned with three main issues. One, the cliff edge or hard Brexit outcome without a transition period. Number two, market access if there is a loss of passporting authorizations or a challenge to equivalence in outcomes-based regulatory assessments. And number three, ensuring contract continuity. That's the ability to continue servicing existing financial contracts, especially derivatives contracts. That challenge, ensuring contract continuity in particular, requires consideration of the need for a public sector solution sooner rather than later. We understand that the Bank of England and the European Central Bank are working on this issue, and we urge that their findings guard against financial instability. So, even if the UK and EU secure a timely withdrawal agreement with a transition period, uncertainties remain, and Treasury and FSOC will continue to monitor the situation closely. Thank you, Mr. Chairman. Mr. Secretary.
Thank you very much. Appreciate the presentation. Now let me turn it over to several other members for their comments. Chairman Powell.
Thank you, Mr. Secretary. So, given the global nature of finance and trade, challenges for one economy or banking system can have global implications. And as with other agencies around the table, the Fed maintains strong relationships with our counterparts in the UK and the EU. And we have regular discussions on ways to minimize the impact of potential economic and financial market disruptions, such as Brexit. The UK and the EU have close economic ties, and officials on both sides are working hard to renegotiate the rules of their relationship. But this is a highly complicated process, and it is difficult to quantify the exact impact of Brexit on the UK or the EU, but it is safe to say that a disorderly Brexit will have some spillover effects into the United States, both through direct channels such as financial markets and banks, as well as potential indirect effects. And we've been in close contact with U.S. banks regarding Brexit preparations for quite some time. And the largest U.S. banks, the G-SIBs, with material UK exposures, are implementing plans to address business continuity, and they're executing on long-term changes to their operations, assuming that they may lose their passporting rights to the EU. U.S. bank exposures to the UK are small relative to their capital levels. By the same measure, exposures of U.S. banks to the EU, not including the UK, are more significant, which suggests that a slowdown in the EU economy following Brexit could indirectly affect those banks and their profitability. Further, we are monitoring legal developments that may affect the financial sector, such as the continuity of OTC derivatives contracts, the ability of central counterparties in the UK to continue to clear derivatives for EU clearing members and their customers, and the ability of UK domiciled payment systems to continue to provide cross-border settlements in certain EU jurisdictions. The large size of these key markets and activities suggests that continued uncertainty in these areas increases the importance of reaching effective solutions to avoid financial stability risks. We appreciate the challenge to come to an agreement on key points of the UK's withdrawal and the efforts that all authorities have exerted to date. But there is some uncertainty about the course of events going forward, and for this reason, we'll continue to support strong capital levels at U.S. banks and strong risk management standards at critical financial market infrastructures. Thank you, Mr. Secretary.
Thank you very much. Chairman Giancarlo.
Thank you, Secretary. As regulators of the world's largest derivative markets, the CFTC monitors carefully developments in Europe, especially in London, which has emerged as one of the key service centers for the global derivatives markets. We advise the FSOC on issues concerning these markets, and we're concerned that a hard Brexit would have immediate and significant impact on the global financial system, including U.S. banks, which account for between 40 and 60% of activity in the global derivative markets. And U.S. non-financial institutions may also be affected by a hard Brexit, effects that could be significant and long-lasting. We're informed by recent publications by the Bank of England and the IMF on concerns that we're following. And those concerns are specifically four matters in the case of a hard Brexit. The first, and perhaps the most significant, would be derivative CCPs based in the UK being forced to offboard EU 27 firms and move their clearing activity away from the UK. And that would take place as much as 90 days before a final Brexit date. Second, we're worried about contract continuity, with UK firms losing the authorization to service uncleared over-the-counter derivative contracts and insurance contracts with EU 27 counterparties. Third, we're concerned with the inability to find replacement contracts, with EU 27 firms losing the ability to use UK exchanges for hedging and risk management and needing to find alternatives that in most cases do not exist in the EU 27 countries. And finally, we're concerned about the impact on legacy swaps, with Brexit-related amendments to swap contracts being viewed as the creation of new swaps and subject to a panoply of swaps regulatory reforms. We believe there are a number of financial stability risks as a result of these matters. We believe a move like this would be unprecedented, moving potentially trillions of dollars of notional amount of swaps exposures across CCPs in Europe in a matter of weeks. We believe there's a potential fire sale potential with non-EU 27 financial institutions being challenged to absorb all EU 27 open positions. Potential for bank distress with write-down of swaps positions that could cause stress in the EU 27 bank sector. We're concerned about increasing concentration of an exit of EU 27 banks from client clearing could exacerbate concentration of activity with other non-EU 27 banks. We're concerned about operational risk. A movement like this is unprecedented, and we're concerned about an operational risk failure in the course of it. And the exit of products, players, and relationships could reverberate globally and have a global impact, both on trading markets and underlying banking service in general. Thank you.
Thank you very much. Chair Clayton.
First, I want to thank my FSOC colleagues for their cooperation on this issue to date. Unfortunately, I expect that cooperation will intensify over the next several months. Two general points. First is that, as reflected in the prior discussion, the range of potential outcomes here is broad. The range of outcomes depends on a lot of factors, and I think that we're all realizing that some of these factors are beyond the control of regulatory authorities. In particular, it is possible that the material consequences of Brexit will begin to manifest themselves prior to March of next year as public and private sector actors take actions in anticipation of Brexit. For example, financial firms and manufacturers may choose to move operations, novate contracts, take on risk or de-risk in anticipation of a Brexit event. I think we need to be cognizant of this and that the effects of Brexit may begin to manifest themselves long before a current deadline. A couple of things that we are doing at the SEC in this regard is we are monitoring the disclosure of our issuers, our public companies, and how they are communicating the potential effects of Brexit to their shareholders and other market participants. We're also monitoring how our financial services firms, as Chairman Powell noted, are preparing for Brexit and whether they will be able to continue to service their customers and communicate with their customers as developments and risks emerge. I think there's work to do. Thank you.
Thank you. Are there any other council members that would like to make any comments? Okay, thank you very much. Then I'll turn to our final agenda is to approve the minutes of the council's last meeting. Is there a motion to approve the resolution approving the minutes of September 12th, 2018?
So moved.
Is there a second?
Second.
All in favor?
Aye.
Any opposed? Thank you very much. Before we adjourn, does anybody have any other business to raise? Thank you very much. Can I have a motion to adjourn?
So moved.
Do we have a second? Second. Thank you very much. The meeting is adjourned. Appreciate everybody coming.
Thank you.
birthday, baby.